During August, we continued to see large cap U.S. equities lead the way.
The housing market has been on fire of late.
There is potential for a pullback as we head into the election. It's unprecedented how many times we've used the word unprecedented.
So let's start off with a recap of August. It was another stellar month for the market. So take us through what happened in August.
Yeah, the month of August, the S&P 500 in total return terms was up over 7%. So just adding to those strong gains. Year to date now, the S&P 500 up almost 10%, which is crazy to think about when you think just a few months ago, we were sort of in the depths of this COVID-19 crisis. So the rally has been extremely strong. During August, we continued to see large cap U.S. equities lead the way. They've been dominating global financial markets year to date over the past year, 3 years. So you saw gains in other areas of the equity market, U.S. small caps, foreign stocks, but just not to the magnitude of some of those large cap names. And then the fixed income markets were relatively quiet. We saw a slight increase in treasury yields, but not a lot of action going on there now that the Fed has basically taken control not only of the treasury market, but even areas of the corporate bond markets as well.
So let's take a look specifically at the U.S. stock market. And I mean, it's been if you just look at this chart, it's been an incredible drawdown and recovery in an unprecedented short amount of time.
Yeah, August was a key month because we got back to all-time highs. So that means the bear market is officially over. So in all these technical terms, if from peak to trough you go down more than 20%, that's considered a bear market. So in about a month's time, from late February to late March, the S&P was down 34%. So in terms of speed, that is an extremely sharp drawdown to be that much that quickly. And it was almost symmetrical, the recovery, to fully recover in about 4 months. The speed of this drawdown, the speed of the recovery is very unique. This was a very unique bear market. You also saw that we never retested the lows or double bottomed, which is very unique for a bear market for this type of price action. So we definitely tried to put that into context of historical market environments just to show how unique this really has been.
And you could say we're still in a bear market for most of the stocks in the S&P 500.
Yeah. The S&P 500 becoming less and less of a good representation of the broad market. So you have to take all of this stuff with a grain of salt. You have to take the S&P 500 price chart with a grain of salt almost now. But yeah, we took a stab at just putting the speed of this drawdown and recovery into perspective, historical perspective. And so here we're looking at every drawdown on the S&P 500 of 10% or more. And on the vertical axis, we're measuring the severity of the drawdown. So the further down you are, the worse it was. So you see COVID-19 down 34%. It's pretty bad. I mean, obviously not close to the global financial crisis or the tech bubble where we were down over 50%, but pretty sharp. And then on the horizontal axis, we're measuring the duration of the recovery. How many months to get back all your losses? The further left you are, the faster the recovery was. And so you can see COVID-19 was very unique in terms of the speed of the recovery. To basically recover all of your losses in 4 months, given that you just lost over a third of the index value. There are no other historical drawdowns below COVID-19, meaning more severe than COVID-19, that have recovered this quickly. Usually when the index loses a third of its value, it takes 1 to 2 years at best to recover all those losses, and we're talking about 4 months.
We've talked about the MAGA stocks a lot in the past, and really putting into context what has actually happened with the S&P and where it sits today and what the returns would look like for the other 495 stocks.
MAGAF, so Microsoft, Apple, Google, Amazon, Facebook, those are the 5 largest S&P 500 index constituents. They're dominating the index at this point. They're now 24% of the index. So basically the most concentrated or top heavy the S&P 500 has ever been in the modern era, at least. And what we're showing here is, year to date, the average MAGAF stock is up over 54%. You take the rest of the index, the other 495 names, and they're actually down 2.8%. And so you just think of that disparity and you think, well, that actually, that down 2.8%, that probably feels more right given everything that's happened this year, and how much the fundamentals have really deteriorated. That feels more like a better representation of the market. And these trends, they're huge over the past year, over the past 3 years, 5 years. These stocks totally dominating. And so that's why we say now, the S&P 500, it's basically the S&P 5 and then the rest, the other 495. You almost have to look at them separately.
Give the viewers context on why we think these 5 stocks in particular, or generally the tech stocks, have really just run up like this.
Yeah. So investors in general have been favoring growth stocks with very lofty growth expectations that have very high expectations for sales and earnings growth over value stocks, which are cheap, trying to buy them cheap with a margin of safety. They've just been favoring those stocks really for the past 10 years. And now it's reached a fever pitch. So there's a bit of a style preference within the market. We've also seen the composition of fund flows favor these types of stocks. And what we mean by that is every marginal dollar that's coming into the equity market, the majority of it is going into passive indexed products. And these stocks dominate passive index products. So every dollar that comes in over the past year, we estimate these stocks have gotten 20 cents or more of it that's coming to the US equity market. So that's been a huge trend. And it's just flows chasing flows. These are going up literally because they're going up. And that's how indexes are constructed. So there's that. And then there's an element where this has been accelerated by the idea that these companies' business models benefit tremendously from a shift to more technology, stay at home forever. So there's a bit of this COVID-19 has been sort of almost a preferred habitat for these stocks.
Right. And they're going up largely because there's no volume as well, that there's far more buyers than there are sellers right now. So they bid the prices up a lot higher in low volume. And that's what creates the index differentiation at some levels.
In another way, taking sort of a broader and longer term historical view at this severe dislocation we're seeing within the market. And if we focus in on the dark blue line, what that's measuring is the performance of the value factor, or US value stocks minus growth stocks. And think of this dark blue line as a collection of dots. Each dot measures a 10-year look back. And this data goes back to 1926. So what you'll see is from 1926 until the year 2000, value stocks outperform growth stocks like clockwork. The blue line is above zero. And it's very logical. This is, the idea is you buy low and sell high. You buy cheap things, value stocks, and you sell them when they're more expensive. And so that's a very reliable historical strategy. It's fallen out of favor previously. The first instance was the tech bubble in 2000. Value underperformed growth, but you can see how it snapped back. So this has been largely mean reverting. But then you just look all the way to the bottom right of the chart and you see where we're at now. And this has been the most difficult 10-year performance period for value stocks relative to growth stocks ever in the history of this data. And moreover, the most difficult 6 months. So the first 6 months of 2020, value underperformed growth by 29%. The last time we were anywhere near that was the absolute height of the tech bubble. Value underperformed growth by 28% in those 6 months leading up to the tech bubble burst. And we know what ultimately happened. The 12 months after the tech bubble burst, value outperformed by 66%. So, the things we know, value still is a historically reliable strategy. It can fall out of favor, but it has a tendency to mean revert. And if or when it mean reverts, it likely will be quick. It will be probably significant. We just don't know when.
The difference now is there's far more money in index funds than there was previously when these things happened. What impact will that have on the potential reversal of this trend?
Yeah, there's definitely potential that maybe we don't revert back as strongly as we otherwise would have, because in order for this rotation to happen, you have to have active investors investing differently than the index, saying, I'm going to invest in these smaller value names that are cheap, and I'm not going to invest similar to the index. So there are just fewer of those active investors out there. So maybe we don't get as strong as a recovery, but still you would expect some type of a rotation over the long term, just given how stretched and extreme this trend has been. I mean, it's to the point, if you believe in long-term mean reversion, going forward, 10-year return expectations now for value are over 11% annualized, right, versus growth negative 1.8%. So, if you're a long-term investor, value stocks right now, given how cheap they are, have a much higher expected return. And then say they only come back half as much, they don't fully mean revert. All right. Well, still, you have such a margin of cheapness that it's probably they're probably still looking attractive value stocks.
Yeah. What impact would outflows have in an index world on the value growth trade-off?
That's another way this rotation could happen, not by people bidding up value stocks, but more by just people selling what they own. And they own growth stocks. They don't own value stocks. So if there was just broad outflows from index products, then you could have a situation where, maybe value stocks are flat or slightly down, but growth stocks are down much more significantly. So this trend could catch up in that way as well, just by value outperforming on the downside.
The housing market has been on fire of late, and we've seen a lot of surprising numbers there. So take us through the chart here and put this into context for us.
Yeah, you would expect, given that we're in the most significant economic drawdown since the global depression, that the housing market would not be basically on fire in a good way. So there have been a couple trends here that COVID has really accelerated. One is the movement out of urban areas and household formation by millennials. So both of those trends have put a lot of demand for new and existing home sales, particularly in suburban areas. So what we're looking at here is the 3-month change in the new home sales and existing home sales index levels. And all the way to the right, you can see this is the most rapid 3-month increase in new home sales and existing home sales that we've seen as far back as the data goes. So yeah, you could see there was a big drawdown there in COVID. Basically, there were no transactions because we didn't know how to, buy a house when you're not looking at it. But now a lot of people are very comfortable with that. 50% of new home sales are bought without even looking at the house, or existing home sales now, without even actually seeing it physically. Yeah. Half of recent sales are done sight unseen. So just tremendous trends. And the other thing that factors into this is this doesn't happen if consumers' balance sheets aren't in good shape. And that is something that has been very unique about this crisis that we've talked about over and over again, is the stimulus and the recovery in asset prices. The overwhelming majority of consumers, their balance sheets are actually in very good shape, quite different than what happened in 2008, where it took a long time for financial assets to recover, and we know what happened to home prices. So the housing market is definitely in a very, very strong position.
Who's buying these houses, given the fact that we keep hearing from lenders that lending standards have tightened significantly, and you see basically a collapse in loan officer support for lending?
Yeah, it's primarily been young professionals getting into the tier 1 and tier 2 housing tranches in terms of price. So there hasn't been as strong of an uptick or in sales in the very high end of the market, because you've particularly seen lending standards tighten for jumbo loans. Those are very difficult to get. But if you think about a young millennial family moving out of an urban area into a modest suburban home, and their balance sheet is fine, and they're employed in a sector that maybe hasn't been so devastated by COVID, that's a loan that lenders are willing to make. And then also, if you look at the spread a lot of these lenders are making now, 30-year mortgage rates versus what they can borrow money at short end, they actually make a decent margin now, given what the Fed has done, lowering short interest rates so much. So that area of the market has definitely been driving these gains.
Let's move on to sort of get a little more global perspective on what the monetary stimulus looks like, and the historic increase across the globe in money into the system. Take us through this chart here.
Yeah, we're looking at the assets of the Fed, the Bank of Japan, the European Central Bank, and the People's Bank of China. So the major global central banks. And the black line sums their assets. And you can see all the way out to the right, combined, their assets have increased by over $5 trillion in about 4 months. You think about that, that's like out of thin air, they've just created another Japan. That's the size of the Japanese economy and also the size of the Japanese financial markets. And that's the third largest country in the world. So just in 4 months' time, they've created the financial equivalent of the third largest economy in the world out of thin air. Their balance sheets have no restrictions. They can do this infinitely until there are consequences down the road, maybe in terms of inflation or rising interest rates or loss of confidence in the currency. But we put unprecedented. It's unprecedented how many times we've used the word unprecedented. But to add $5 trillion US dollars worth of assets to your balance sheet combined in 4 months, and we're coming off of a very high base. That's huge. A 25% increase, given that central bank assets had dominated financial markets coming into this crisis. To increase them by another 25% in 4 months is just, it's tough. It's tough to wrap your head around what they've done.
And just what's our outlook for the next 12 months in terms of central bank assets?
Well, they're all in. So you view it as sort of you're all in at the poker table, but you can just create chips out of your pocket if you want. So if they need to increase stimulus, they can do so, and they've all basically committed to that. So as long as financial markets have recovered and the economic recovery globally is stable, then they probably won't feel the need to dramatically increase their balance sheet and to continue to buy more assets. But if either of those two things, those two assumptions are violated, if the economic recovery, if it takes a pause or it starts heading the other way, or there's any type of volatility in financial markets, they're going to buy more assets.
What is our thoughts on terms of what the next 60 days might bring and why we're seeing this, I guess, acceleration here in the last week or so in the market?
Yeah, some of the recent gains, strong gains that we've seen, you can probably attribute to the Republicans staging a bit of a comeback here recently. They're still the underdogs, so the expectation would be if that were to continue, we could move higher. But you just have to keep in mind that the pace of gains we've seen have been so strong, and the technicals supporting the market have not been very favorable. So it's quite likely that we could get a bit of a bump here if Republicans continue to stage a comeback, but we should settle into some type of a trading range with higher volatility than we've been experiencing. And you would think there is potential for a pullback as we head into the election.
Yeah, I think that's the key is the direction might be hard to determine, but the volatility level should increase as things start to get noisier and noisier.